Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us for this segment is Phil Mackintosh, Chief Economist at Nasdaq, to discuss if the economy is partly righting itself. Phil, it's great to see you again. Welcome back to Trade Talks. And let's talk about some of the things that could be positive for the economy. We'll start with COVID data. Seems to be that it really is improving, at least in the New York area.
Yeah, I mean, America-wide, the cases that had spiked well above any of the previous spikes are now down about 50%. But to your point, New York got the Omicron spike relatively early, and now we're back down to about a fifth of the cases, a lot less hospitalizations too. So the news is good for Omicron. It was just like people were saying early on, a very sharp but a short spike. And so if we're lucky, it's going to be a short impact on the economy as well.
Right. And one thing that was a little bit tricky was, of course, the market action that we saw in January really was one of the more volatile starts for a new year that I can remember in some time.
Yeah, it was tough for stocks, wasn't it? And part of that was because the Fed, as we've been saying, has changed so quickly from rates are going to be low forever, accommodative, to, oh, actually, inflation is something we should probably look at and start to tackle. It's a little bit more embedded. We're starting to see wages rise. And so the Fed rhetoric really changed in January. They're kind of committed to doing rate hikes during this year, between 3 and 5, based on different people in the market's expectations. And that'll get us close to 1% by the end of the year for short-term rates. So that's a big change in just a couple of months in terms of what people's expectations were for interest rates. And obviously that affects valuations too.
And then, of course, well, let's talk about the valuation impact, because that was one area of the market where it needed to come back down to earth. And I think this was the reason that people were looking for to right size valuations a bit here.
Yeah, and obviously with the growth stocks where the valuations factor in longer term earnings growth, they were the ones that were hit much more than some of the value stocks. So you definitely saw the tech sector, you saw growth stocks, you saw a lot of small cap stocks being hit a lot harder than some of the broad market. One sector that was a winner, though, was energy, and that's because the price of oil and also the price of gas in Europe has gone up. It's gone up quite a lot. A lot of that's because of the Ukraine tensions, but also just supply shortages globally. The US market hasn't really started fracking again, and so there's not really enough supply if we do get back to the full economy and full strength again. So the energy sector has been a big winner on that front.
And finally, let's talk about the data itself, the impact that we're seeing with GDP, retail, and manufacturing, and why you think this could potentially be a way for the economy to right size itself and not necessarily be so dependent on Fed policy.
Yeah, so the last week or so, we've actually seen quite a lot of real data that's got nothing to do with the interest rates going up. And you're right, like, so the GDP number over 5.5% last year is quite flattering, but in a way, what happened in the last quarter is probably more important. And a lot of the positive result in last quarter was because of inventory build. And so that sort of speaks a little bit to the fact that all the supply chain bottlenecks are starting to clear. If companies are now starting to build up inventory, obviously spending, which we saw, consumption dipped as well. So whether this is because of Omicron and everybody stopping going to restaurants, or it's just because people are running out of stimulus checks and they're spending less, the supply chain bottlenecks, just looking at the GDP numbers, looking at the spending numbers, seem to be starting to relieve themselves. And we talked about that before. The supply chain bottlenecks have created price pressures on imports, price pressures on products for the companies trying to manufacture for their inputs. And so we're starting to see that come away as well. So the prices are coming back down, the delays and the bottlenecks coming down, and the Fed hasn't done anything to rates yet.
All right, Phil, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.